Welcome back to the Deep Dive. Today, we're digging into the Q2 2025 earnings call for IRIDEX, that's ticker IRIX. The results came out after hours, back on August 12th.
Right, and IRIDEX, well, they've been on this, let's call it a self-help journey for several quarters now.
Yeah.
Really focused on, costs and efficiency.
Getting lean.
Exactly. So the big question was how that would show up in the Q2 numbers, and maybe why the market reacted the way it did afterwards, because it wasn't straightforward.
Okay, so let's hit the highlights first. The results themselves. Revenue came in at $13.6 million. That beat the $13.1 million consensus, which is, pretty decent.
It is. And that's, 7% growth compared to last year and 14% sequential growth from Q1. So solid top-line movement.
And the bottom line, how did the cost-cutting play out there?
Well, GAAP EPS was still negative, minus 6 cents. But that was actually 3 cents better than the minus 9 cents expected.
Got a beat there, too.
But the really crucial number, the one everyone watching this turnaround was focused on, was the non-GAAP adjusted EBITDA. And that flipped positive, just barely, $0.02 million, but positive nonetheless.
Wow, okay. So from a loss of, was it last year?
A loss of $1.7 million in Q2 2024. So yeah, massive swing. Structurally, that's a big deal.
So third quarter in a row now with year-over-year growth and positive adjusted EBITDA and lower operating expenses driving it. That feels like, the plan is actually working.
On the cost side, absolutely. You have to give management credit there. They seem to have established a kind of structural cost floor. That's a genuine operational win.
I sense a but coming.
Yeah. The market clearly wasn't just looking at the cost floor. It wants, profitable growth. The stock dropped, over 9% the next day?
Ouch.
Yeah. And that skepticism, it really zeroed in on the trade-off IRIDEX apparently made to hit those revenue and EBITDA numbers.
Okay, let's dive deeper then. The cost story first. How much did they cut?
Operating expenses, OPEX, were down a massive 28% year over year, landed at $5.6 million. That's a direct result of the aggressive cost-cutting they started late last year. It's really the engine behind that improved EBITDA.
28% is huge. So mission accomplished on OPEX.
Pretty much, yeah. The heavy lifting on reducing operating costs seems, largely done. But profitability isn't just low costs, right? You need healthy margins, too.
And that's the pressure point you mentioned.
Exactly. Gross margin, GM, it fell sharply, down to 34.5%.
Whoa, from what?
From 40.7% in Q2 last year. That's a 620 basis point drop.
620 basis points, that's not noise. That's a serious hit. Almost a 15% decline in the margin rate itself. What happened?
Management pointed to product mix. Specifically, they said console sales were materially higher, and international sales were also strong.
The classic razor blade issue. Consoles are the low-margin razor.
Right. The capital equipment sale. It boosts revenue, but doesn't help margins much. The profit is in the blades, the high-margin recurring pro.
So more console sales means the overall revenue mix becomes less profitable?
Precisely. The growth was driven by the less profitable part of the business. Yeah. And then you add in the international sales piece.
Which are also lower margin. Why is that?
Usually because they use distributors overseas, right? So the distributor takes a cut. Plus, they mentioned tariffs and inflation hitting their cost of goods sold, their COGS.
So it was kind of a perfect storm hitting the gross margin line.
Yeah, that's a good way to put it. Console-heavy mix, international distributor margins, tariffs, inflation. Yeah. It all just compressed the GM.
Okay, what about cash? With margins down, were they burning through cash?
Their cash position is still tight, yeah. $6.8 million at the end of the quarter. But because the OPEX was so much lower, they only burned about $7.4 million from Q1. So the bleeding slowed way down.
And they're sticking to their full-year guidance. Break-in cash flow and positive adjusted EBITDA for 2025.
They are. On revenue, consistent with 2024 was the phrasing. It's achievable, but definitely tight, which highlights why these long-term cost fixes are so important.
You mean beyond just the OPEX cuts?
Yeah. They mentioned they're negotiating with their contract manufacturers right now to try and lower COGS. But the really big one, the structural shift, is tied to their facility lease.
Right. They mentioned relocating. When does that lease expire?
August 2026. And this isn't just, moving down the street. Their current lease is in Mountain View, California.
Silicon Valley rent. Oh. Ouch.
Exactly. One of the most expensive commercial real estate markets, period. Getting out of that lease in 2026, that's not just trimming costs. That could potentially wipe millions in fixed costs off the books. It completely changes their long-term operating leverage profile.
But that's still, 2 years away?
Yep. 2 years of waiting for that big structural relief.
Yeah.
Delayed gratification for investors, you could say.
Okay, let's pivot to the actual operations, that razor blade model. Where did the sales come from? Which segments performed well?
Well, the Retina segment did really well. That's the Pascal system mainly. Revenue hit $8.0 million, up 10% year over year.
Solid growth there.
Yeah, and U.S. sales were particularly strong. So strong, actually, that they ended the quarter with a backlog carrying into Q3. So good momentum, clear demand for Pascal.
But the glaucoma segment, the Cyclo G6, that's the high margin probe driver, right?
That's the one. And total revenue there was flat year over year, $3.3 million.
Yep.
And they only sold 35 G6 systems in the quarter.
Only 35. And the probes, that's the key metric for margin.
And that's where the problem lies. Probe shipments were, quote, materially lighter than expected. 13,100 probes shipped.
Compared to
15,100 last year. So a noticeable drop. Management blamed supply constraints late in the quarter.
And they said those constraints are resolved now.
That's the claim, yes.
Okay, but forgive my skepticism. We've heard supply constraints before from companies when maybe utilization or adoption is the real issue. Can the market trust that explanation?
Look, that's exactly the question analysts were asking, implicitly or explicitly. Because whether it's a genuine temporary supply blip or whether it reflects weaker demand or lower utilization of the installed G6 base, the result is the same. Fewer high-margin probe sales.
Right. It hits the most profitable part of their revenue stream. The whole G6 strategy depends on getting that installed base to use more probes.
So how are they planning to fix that, assuming it's not just supply?
Well, they highlighted the new Medicare LCDs.
LCDs, local coverage determinations. Remind us what those are.
Basically, they're guidelines used by regional Medicare officials to decide if a procedure is covered, like if it's medically necessary. The hope is that these new LCDs might allow the G6 procedure to be used earlier in treating glaucoma.
So moving it up from a last resort treatment?
Potentially, yeah. If they can position it earlier in the care continuum, that could significantly broaden the patient pool and theoretically drive much higher probe utilization over time. It's a potential tailwind.
Got it. What about those international headwinds you mentioned, besides the lower margin?
Yeah, it wasn't just margin dilution. Execution was tricky, too. The Pascal rollouts in Europe and parts of Asia got held up by MDR certification.
MDR, that's the European Medical Device Regulation. Yeah, the new stricter rules in Europe, getting that certification is a big time-consuming process, so it acted as a drag on sales there. And then they had separate logistics delays hitting Japan.
Okay.
Plus, remember the talk about potential China tariffs? Apparently that caused a rush of orders from distributors trying to stock up, which then strained their whole supply chain. So just a lot of friction internationally.
Right. So putting it all together, they nail the OpEx cuts, deliver positive adjusted EBITDA, big check mark there. But then, boom, gross margin collapses and the crucial G6 probe number misses expectations again.
And the market reaction makes sense in that context, right? The stock gets hammered.
Because the market's saying, great, you cut costs, but you still can't sell the profitable stuff reliably.
Essentially, yeah. I think there's a sense of patience wearing thin. Investors see the progress on costs, but they're spooked by the recurring margin compression and the lack of clear visibility on when or even if that high-margin G6 probe engine is going to fire on all cylinders.
And that 2026 facility cost saving is just too far away to matter right now.
It seems like it. The market wants proof of profitable growth now, or at least a clear path to it very soon. Deteriorating gross margins send the opposite signal.
Especially when the stock's already underperformed so much. Down almost 30% over the last year, even while, the broader medical device index was slightly positive.
Exactly. There's just no cushion for disappointment right now. So the whole narrative, the hinge for getting the stock re-rated, it's completely shifted.
It's not about OpEx anymore.
No. It's all about gross margin repair and G6 probe utilization recovery. Hard data. Investors need to see evidence, probably in the next quarter or two, that the manufacturing cost negotiations, the new LCDs, something is starting to lift that margin back up.
Before the 2026 cavalry arrives with the facility move.
Precisely. Those next couple of earnings reports, specifically the GM and probe numbers, feel almost existential for the current investment case.
Okay. We've laid out the operational story, the financial friction, the market reaction. Now, let's get to that segment. This is not financial advice. Let's be absolutely clear. We're just gaming out a scenario, an outrageous but maybe plausible idea based on everything we just discussed.
All right, so my thesis here is basically playing on that disconnect. The market is punishing IRIX today for the immediate margin pain and the G6 probe uncertainty.
While completely ignoring that massive locked-in cost relief coming in 2026 from the facility move.
Exactly. It's quantifiable, it's scheduled, but it's too far out for the market's current focus. So you have near-term pain priced in, but potentially huge long-term structural improvement not priced in.
So the trade idea is
leverage that time horizon difference. You could look at something like a long-dated, deep discounted bull call spread, maybe using options that expire way out, like Q4 2026.
Okay, a bull call spread, limiting your upside, but also significantly reducing your costs compared to just buying calls, and targeting late 2026 expiry.
Right. It's essentially a bet that, okay, the stock might bounce around, maybe even drift lower for the next year or so, reacting to these quarterly margin and probe numbers.
But as that August 2026 lease expiration date gets closer,
the market will be forced to start pricing in the reality of that massive fixed cost reduction, millions potentially coming straight off the operating expenses. Plus, maybe by then, the COGS negotiations bear fruit too.
So the spread aims to capture that anticipated rapid adjustment higher in the stock price as 2026 approaches, capitalizing on the market finally recognizing the improved structural profitability.
You're basically trading today's G6 angst and margin worries for the eventual, almost guaranteed impact of that facility relocation and potentially a more normalized cost structure. It connects the near-term noise to the long-term structural fix.
That's definitely leaking outside the box, using the calendar itself as part of the trade structure. Okay, let's wrap this deep dive on IRIDEX Q2. The summary seems to be huge success on cost control, OPEX down 28%, positive adjusted EBITDA achieved.
Check. But major challenges remain on profitable execution. Gross margin down 620 basis points is the big red flag, driven by that console-heavy mix and the persistent weakness in high-margin G6 probe sales.
International friction isn't helping either.
Right, so the core tension is clear. Management's pulling levers, they mentioned, using tools like MedScout to target accounts better, banking on the new Medicare LCDs to boost G6.
But the question for you, the listener, is really this. Can those efforts create a significant enough turnaround in probe sales quickly? Quickly enough to fix the margin problem before that big 2026 facility cost relief kicks in?
Or is the company and the stock likely stuck in this kind of volatile holding pattern until that structural cost burden is finally lifted 2 years from now? That's the debate.
Great stuff. Let us know what you think, especially about those key metrics, gross margin and G6 probes. Where do you see them heading in the second half of the year? We'll catch you on the next deep dive.